Credit is important. It affects many parts of your life. Good credit can help you get a loan, rent an apartment, and even help you get a job. On the other hand, bad credit can make life hard, limit your choices, and cost you more money and interest. Good credit means you have a good credit score. This score is a number that shows how well you manage debt. Lenders use this score to decide if they will lend you money and how much interest to charge you. Having a good credit score can save you money. With good credit, you get lower interest rates, which means you pay less over time and have more choices to pick the best loan for you. Building good credit takes time, requires good habits like using credit responsibly, paying your bills on time, and keeping your debt low. Over time, these habits will build your credit score. A credit score is a three-digit number ranging from 300 to 850. The higher the number, the better your credit. A good score is typically above 700. A bad score is below 600. Your score is based on your credit report, which has 5 main parts: your payment history, amount of debt, length of your credit history, credit mix, and new credit. Each part affects your score differently, with payment history being the most important, making up 35% of your score. The amount of debt is next, making up 30%. The length of your credit history is 15%, and your credit mix and new credit are each 10%. Understanding credit scores is key as it helps you know what to focus on, see what lenders look at, and improve your score over time. One way to start building credit is with a secured credit card. This is a special type of card where you need to make a deposit, usually the same as your credit limit. For example, if you deposit $500, your credit limit is also $500. A secured credit card is a good option for beginners because it is easier to get, and lenders see it as less risky since they have your deposit as security. But you still need to use it wisely by making small purchases and paying off the balance in full each month. This will help you build credit. Using a secured credit card also teaches you how to use credit, helps you form good habits like paying on time and keeping your balance low. These habits are important and will help you when you switch to a regular credit card, which usually takes about 6 months to a year. By then, you will have a better credit score and good habits, making it easier to manage a regular card. Another way to build credit is to become an authorized user. This means you are added to someone else's credit card and get your own card to use. However, the primary cardholder is responsible for the bill. Being an authorized user can help you benefit from the primary cardholder's good credit. Their good habits can boost your score, but you need to choose the right person. They need to have good credit, pay their bills on time, and keep their balance low. Talk to the primary cardholder to make sure they are willing to help and trust you. You will need to use the card wisely by making small purchases, paying off your balance each month, and not spending more than you can afford. Being an authorized user has risks. If the primary cardholder misses a payment or maxes out their card, it can hurt your score. So choose carefully and make sure you agree on how the card will be used. Communication is key. A credit builder loan is another option. This is a special type of loan designed to help you build credit. You borrow a small amount of money, but you do not get the money right away. Instead, it is held in a savings account. You make monthly payments, and once the loan is paid off, you get the money. A credit builder loan helps you in 2 ways. First, it helps you build credit. Your payments are reported to the credit bureaus, which helps improve your score. Second, it helps you save money. At the end of the loan, you get the money in the savings account. To get a credit builder loan, you need to find a lender. Many credit unions offer these loans, and some banks do too. You will need to apply. The lender will check your credit, but these loans are usually easier to get. Once you get the loan, make your payments on time. This is important. Late payments can hurt your score and can also cost you extra fees. So set up automatic payments if you can. This will help ensure you never miss a payment. Using credit wisely is key. It helps you build good credit, avoid debt, and achieve your financial goals. There are a few key habits to follow. First, pay your bills on time. This is the most important habit. Late payments can hurt your score and can also cost you extra fees. So, set up reminders, make a budget, and use automatic payments if you can. Second, keep your debt low. Do not max out your credit cards. Try to use less than 30% of your credit limit. For example, if your limit is $1,000, try to keep your balance below $300. This shows lenders you can manage credit. Third, do not open too many new accounts. Each new account can lower your score and can also make it harder to manage your debt. So only apply for credit when you need it, and do not close old accounts. They help your credit history. Fourth, check your credit report regularly. Look for mistakes. Dispute any errors you find. This helps ensure your score is accurate and also helps you spot identity theft early. Section 7. Avoiding common pitfalls. Building credit can be tricky. There are common mistakes that people make. Avoiding these mistakes can help you succeed. First, do not miss payments. Late payments can hurt your score. They can also cost you money in fees and interest. So make sure to pay your bills on time. Set up reminders or automatic payments if you can. Second, do not max out your credit cards. High balances can hurt your score. They can also make it hard to pay off your debt. Try to use less than 30% of your credit limit. This shows lenders you can manage credit responsibly. Third, do not apply for too much credit at once. Each application can lower your score. It can also make it hard to manage your debt. Only apply for credit when you need it. And do not close old accounts. They help your credit history. Fourth, do not ignore your credit report. Check it regularly. Look for mistakes. Dispute any errors you find. This helps ensure your score is accurate. It also helps you spot identity theft early. Section 8. Monitoring your credit report. Monitoring your credit report is important. It helps you keep track of your credit. It helps you spot errors. It helps you prevent identity theft. You can get a free credit report once a year. Visit annualcreditreport.com. You can get reports from all three bureaus, Experian, TransUnion, and Equifax. Review each report carefully. Look for mistakes such as incorrect accounts or late payments. If you find an error, dispute it. Contact the credit bureau. Provide any documents you have. The bureau will investigate. They will correct any mistakes they find. This can help improve your score. Consider using a credit monitoring service. These services alert you to changes in your report. They can help you spot identity theft early. Some services are free. Others charge a fee. Choose the one that fits your needs. Monitoring your credit report helps you stay informed. It helps you catch problems early. It helps you keep your credit score accurate. This is important for your financial health. Section 9. Maintaining good credit. Maintaining good credit is as important as building it. It requires ongoing effort. It requires good habits. It requires regular monitoring. First, continue to pay your bills on time. This is the most important habit. Late payments can quickly hurt your score. They can also cost you in fees and interest, so make sure to keep up with your payments. Second, keep your debt low. Do not max out your credit cards. Try to use less than 30% of your credit limit. This shows lenders you can manage credit. It also helps you avoid debt. Third, avoid applying for too much credit. Each application can lower your score. It can also make it hard to manage your debt. Only apply for credit when you need it, and do not close old accounts. They help your credit history. Fourth, continue to monitor your credit report. Check it regularly. Look for mistakes. Dispute any errors you find. This helps ensure your score is accurate. It also helps you spot identity theft early. Section 10. The long-term benefits of good credit. Good credit has many long-term benefits. It can save you money. It can give you more choices. It can help you achieve your financial goals. With good credit, you get lower interest rates. This means you pay less over time. For example, on a mortgage, a lower rate can save you thousands of dollars. On a car loan, it can save you hundreds. This leaves you with more money for other things. Good credit also gives you more choices. You can qualify for better loans. You can choose the best terms. You can get better credit cards with rewards. This can make managing your money easier. Good credit can also help you achieve your goals. It can help you buy a home. It can help you start a business. It can help you save for retirement. It can give you financial security. Building and maintaining good credit takes time. It takes effort. It takes good habits. But the benefits are worth it. Good credit can improve your financial health. It can improve your quality of life. So start building your credit today.